Hello traders, welcome to FreeFX. I'm Francesco. Welcome to my video 121. It's the 15th of August, Monday, and it's quarter past 11 in the evening. So there's been a whole day of trading. The Asian session very early on, then the European session overlapping them with the American session, and that's finished. So we are just after this sort of 1 hour gap between 10 and 11 when nothing happens, and lots to talk about. First of all, statement of intent. I, as you can see here on these positions, I'm basically short. And long story short, excuse the pun, I've actually really got a bit of a conundrum going on, so I'll explain a little bit about that. So, but before we come into that, I just kind of wanted to thank you for being here. And the other thing I was going to talk about is not just my positions, but also the complexity of the situation now, or rather the simplicity, depending on how you look at it. Um, I'm not here to obviously try to convince people of anything, just really doing my little thing, which is looking at TA, fundamentals, market conditions, trying to get different angles on this kind of situation that we're in. So the question that I posted in my last video was, are we in a bear market rally, or is this sort of the new bull trend? What is actually happening at the moment with the S&P, which is what we're looking at here. So the S&P, as kind of John K. Clyder, that I follow a lot, says, it's a very good sort of proxy for, in ways, like a sentiment, in a way, filter or indication of where markets are going, at least for the US, but also globally, because a lot of these companies are obviously placed not just in the US. And the other thing is that by just, it's kind of like a one measure look at markets, as we call them. So it's the 500 biggest companies in the US, and it's obviously going to have survivorship bias, so that all companies that have kind of fallen out of the index are not really represented in what we see now. So, but we're not doing backtesting here, so that's fine. We're just looking as it is now, the S&P. Most importantly is the question still, for me, remains unanswered, and a lot of people on Twitter have commented, a lot of serious commentators who are money managers who run their own money, but there's certainly a question there that nobody's quite answered, and there's been lots of kind of speculation about why this is, but really we are still kind of just creeping up to that point where hopefully there's a resolution one way or the other. And I fear, as we all do, those of us who are short at the moment, that we might have sort of mistimed this. And obviously, it's a concern. As you can see, all my positions are in the red. So it's not a laughing matter. It's quite serious, actually. So I think it's important to talk about the reasons why I'm still not out of those positions, and but I'm very watchful, and other people as well are very cautious about the way they're approaching this currently, whether they moved away from stocks altogether. There was news today that Michael Burry, who was, you remember from the Big Short film, who shorted the US housing market at its boom before the big bust of 2008. He apparently sort of liquidated his, I think S&P or stocks. He's just kind of gone to zero with that, and he's just kind of sitting kind of neutral, something like that. Don't quote me on it, but anyway, it's kind of, there are lots of stories coming out like that, which are not completely untrue, but obviously they just kind of paint a picture of uncertainty, not necessarily bullish or bearish, and that's why I think it's important to get a sense of why we have this uncertainty. I'll show you in a minute why that is. Another thing as well I'm going to talk about today is the fact that I'm a kind of short-term trader, so staying in these positions for a few days and now actually weeks, starting to feel a little bit uncomfortable because it's over my normal time frame. So normally what I would have done is just either have a stop or come out of them altogether, and it's not because I want to be right, it's because I think the projection of the targets is a bit longer in terms of staying in positions, so I'm kind of allowing that time. But I'm kind of going with this kind of new situation, and it's new to me on this index, so I've not met it before in the short time I traded this, because I started September, October last year. I was doing forex before, and not really taking time to understand the S&P. In this time, we changed from essentially a bull market before Christmas, and then into the new year, we switched on to a full bear market. And so, I had to adjust to that. January wasn't a good month at all, and then I got into the new trend, so that was fine. A few good profitable months, except March was a bit low, but still profitable. And then, we got to sort of end of June and now into July was very difficult because went up, but then into August, and again the uptrend seems to be going, but it's kind of diminished in strength, and the volume has been going down a lot. So not sure really, the jury's out, but I'm definitely watchful. So I'm going to show you a few things now, just to kind of make it into the inner sanctum of the video and really kind of go through. So let's start with this chart. It looks quite difficult to read, so I'm just going to take out some things. First of all, let's take out the Bollinger Bands there, and let's take out the weighted moving average there. Okay, so it might be a bit easier to read. So what we see there is two things. The first thing that we see is my face. So I'll move that up there. First thing we see is the S&P 500, and this is the long, let's call it bear market rally, because I still think it's that, but let's call it rally, recent rally. And the second thing we see is the purple line chart, and that is the VIX volatility index based on the S&P 500 30-day implied volatility. So the option side essentially on that. So obviously they're kind of a mirror version of each other, as you can see, and that's a well-known fact. So you could say it's not really a leading indicator in a way, because it's kind of implied volatility based on the S&P on the underlying asset. So obviously the correlation is very strong. Just looking at it, it's unlikely that it will give you any signals. But even so, what is important about it is that there are sort of historical levels in a way that you can look at, and in a shorter term, it has been sitting around similar levels. So you can see that it's not range bound, it's not like an oscillator, a bound oscillator, but certainly we around this, the numbers are here. We're at 1994 currently, so let's call it 20, just under. And if you look back to this time, so March, we were around 1926, and if we look February, it's about 20 something, and then just at the start of the year we're a little bit lower than that before the bear market really started, and we're like 16, 17. So from the start of the bear market, so-called in January, we've been sort of from 19 to 20 roughly. So let's say that 20 is the sort of line in the sand, and as a sort of rough estimate, as I said in my last video, and we just tipped over that today, meaning we kind of bounced off it and stayed above it. But what somebody said today as well, it's interesting that we've picked up whilst this is tipped up. Normally when it tips up and there's a bit of a fall, as you can see here, a few days ago, 21st of July, 22nd, so 25th, 26th. Okay, and we had this rise as well. So we've had a few of these, one here as well. Today was a bit of a tip higher, but really it hasn't really dented this sort of uptrend. So small thing there, but let's leave it at that. The other thing which I mentioned before at the end of my last video on Friday was these 4 points. As you can see from October of last year, we've had these 4 points where there's a switch in terms of the daily ATR 21 period, where we were just below this kind of 70 level, and then we were creeping above it from the start of the year. January we started aiming higher, and we've remained above that level, the 70 mark. Today, interesting that we've just been tipping below that, and so we're now just below, we're at 65.8. Okay, So my line in the sand, in a way, is somewhere around the 70 mark, because that's kind of where we've been in a sort of bear market. We've been above that number. So, and before that, it was a bull market. We were below that number. So, what John Bollinger put in a tweet the other day in response to me posting something about the ATR was that perhaps it's an indication again of lesser volatility in an uptrend or rally, which is sort of what the charts show actually. So that there's nothing really strange about that or indicative of anything. But even so, it's interesting that on the futures side as well, there's been very little volume. So, but let's kind of stay with this for a second. I'm going to hide the VIX for a moment as well, just to get really to the bottom of this, which is this level that we see, as I mentioned before, is the monthly 21 weighted moving average, just kind of where we are there. And therefore, it's kind of where we're struggling at the moment. It's not that we couldn't go past it. So that's number one, as I mentioned in the Friday video, if you want to watch that. The second thing was the 200-day moving average as well. That's another thing. So let's kind of move over now to the future side. Okay, so there's the futures E-minis, the September contract, and you can see the 200-day moving average there. So that is where we are, is the confluence of things. Now, interestingly, that moving average, as you can see, sits at 4317.25. Price is 4293.50. So we're getting really close to that. And I'll come back to that in a minute, which is quite important for options. I'll come back to that in a minute. Now, the other thing you can see, as I said, is a drop in volume. Now, ATR is not the same as volume. So the two things are sort of connected, obviously, but fall in volume is not necessarily a good thing. So if a drop in ATR is a good thing for a rally up, dropping volume isn't. So if you looked at things like Anna Cooling, her book on volume in trading, and Wyckoff and his rules about observing volume with price, you will know, and you know this very well yourselves, that if you have a move that's not sustained by volume, the move is invalidated. Equally, if you have a lot of volume and very little movement in price, that volume per se doesn't validate the move. So in essence, what you need to have is volume and price moving significantly enough relative to previous price action to confirm that a move has volume behind it. And this hasn't been the case. So that's one red flag again. So we're coming up to the 200-day simple moving average up here, and we have been below it obviously since crossing below it earlier on. Now this won't give it to you because it's the nature of the 200-day moving averages on software. Sometimes it's not displayed, and on futures there's an added component of contracts expiring, etc. So you only see it here from March. But we were below it before that, as I showed you before. So we are coming up to that, and it's a very important pivotal moment to see what happens next. As well as that, what we have is, or contrary to that, we've got the advanced decline line. So the advanced decline indicator is a breadth indicator, so it tells you how many stocks are moving higher versus how many are moving lower. So how many stocks in the index are advancing versus how many are declining. As you can see, it's a fair reflection of price. So during the bear market from the start of this year, we've had this declining line, and it's picked up obviously since really since the end of June when this rally started. But more significantly, it's been quite steeply rising since the middle of July. So for about a month, it's been very much gaining ground So that's one thing which other people have also mentioned, and I keep an eye on it sometimes because it is a good measure of that. Um, but the other thing, the third item on this chart, as you can see, is the CCI, which I've used a lot, and so I wanted to go back to it. And going back to it really highlights the situation. For me, again, another red flag. And this is not to find reasons why I want to defend my positions, but again, objectively, these are all things that don't match up. Okay, so what the CCI should show is either kind of overbought or oversold. Essentially, you can use it for that, and you can use it for sort of a contrarian view where you have a divergence with price. Okay, so just to give you an example, I've talked about this many times before in my videos, so sorry if I repeat myself, but if you just come into this video for the first time, the CCI normally set to a 100 above the middle line, which is 0, and which will be about here, and the negative as well. So when it goes into negative, usually it's indicative of a down move. When it goes above the middle line and higher, it's indicative of an uptrend. It goes to 100, that's kind of considered kind of overbought. But actually what I do is I use the 200 as a filter. So because many times the 100 is a false overbought and it actually goes high, especially during trending, it will exceed that quite often. So we're actually looking at 200, even 300, depending on the time frame that you use. On the daily, if I go back, you can see here to early in the year, we were in a downtrend, so we'll be getting closer to the 200 quite a bit, certainly exceed the 100. So as you can see, you'd have had some false signals, going long perhaps as a rebound, but actually, there was a lot of going down to 100 and the 200 as well. We've come off those levels in June and we followed price. Now I've highlighted on the lower time frames many instances of divergence, negative divergence compared to price rising. But on the daily, actually, what I said was that we've had three, 1, 2, and 3, these three humps, and the third of them has been developing almost on par with the second, while price has actually gone quite a bit higher. And thereafter, we've had a true divergence because this to this, as you can see, is quite obviously, and I'm just going to do it really, really obviously. I'll just use a hand from here. Let's do it from, and you can see one there, and then one here. You can see the moves are quite the opposite of each other. What does that mean in terms of trading, in terms of expectations? Well, there's obviously a failure rate when it comes to these things. We can have, many of these divergences not, not actually being honored, respected by the market, and just kind of moving higher still. But again, this has now gone on for about 10 days. And it certainly speaks to, the lower volume, the fact that we are below the 200-day moving average, which is a very important benchmark for trends. All these things mean that we are at a key point in this bear market rally. There's lots of data going around about the superimposed 2008, for example, in 1970 something, different bear markets that we've had in the past, and how there's something about this time in a bear trend where there's a strong up move continued by an even deeper down move. So it's difficult to predict what the market will do, what a particular index will do. In fact, we shouldn't talk about the market. We should talk about the S&P 500. That's what we're talking about here. There are things moving in other directions at the moment. You might have heard of meme stocks and stuff like that. So it's not like this is everything moving in the same direction. But I'm just saying it is. You find a strong correlation if you do a relative strength analysis with other indices, of course. It doesn't happen in isolation. Now, really important here. I just wanted to go to another concept. So we looked at all these things, and I'm going to show you something else as well, which is the open interest heat map for options. Now this is the CME group. website, and you can select your product if you type open interest heat map, and basically that's your address. And then if you select your product, you've got all your different products there, from FX to equities, cryptos, etc., interest rates. Select US E-mini, for example, and you've got also the other ones there, Nasdaq. These are all the E-mini contracts. You've got the micros as well. So how I'd used this in the past, and I've used it for Forex, not much for S&P, so I've come back to it after many months. But I thought I had a look at this and then share it with you. If you've used this a lot, please tell me if you've got any tips on how to use it, because I use it in a quite limited and maybe very basic way. And if you're an option trader, you might want to tell me off for not really using it to its full potential. But the way I use this is looking at the change. So you see open interest change, for example. You can also look at it as just the open interest, and we'll just give you the figures. But then you have to kind of work things out yourself. So I'll put it as a change in percentage, and see that. What's really interesting is if I just bring this to a slightly higher visual. Now, I'm just going to go back. So we are at 4292 at the moment on the S&P. Okay, 4292. 4292. So we're just around here. Okay. Now, what you'll notice is the puts. These are the puts, calls and puts. Okay, so let's go up and see. These are the contracts, calls and puts. The puts for 4310, which is obviously a higher price than we're at the moment, and not too far because we're at 4292, remember, so we're only 2 bands away from this. The change in puts, so essentially sell the S&P. Very simplified explanation. I know there's more to it than that, but let's say that calls is a long and puts is a sell. Let's put it like that, okay? So that kind of we're clear how I'm looking at this. For 4310, the change has been this 392.31 contracts, okay? And there's nothing of that magnitude in the nearby prices that has that much change. So there's been an additional number of contracts of puts to the 4310, okay? So that's kind of expecting that when we get to that level, we are hedging, or there's an expectation of the price falling at that level, meeting resistance. I don't know what exactly I should see into that, but let's just look at the price 4310, because if I go back to my 200-day simple moving average, you will see that it sits at 4317 up there. That's the number, 4317. Okay, 4310, increase in options puts at 4310. 4317, 200-day moving average. And also we're roughly at the 21 weighted moving average on the monthly chart. So we definitely have something there that tells me that this is a significant level that either is going to hold, and this thing is just going to start resuming the downtrend and maybe gather momentum, or maybe not, maybe a temporary thing. I don't know, but there'll be either a pullback or there'll be some kind of reaction to that price. So that's another level of resistance, if you want to call it that. Okay. So I'm just going to close that because we have dealt with all these things, and that leaves us with what is happening next week. Well, clearly, let's have a look at this, and it's basically FOMC meeting minutes week. Tomorrow, Tuesday the 16th, we've got United States building permits. What's interesting about this is that, again, we're looking at the consensus and the previous. So the previous and the consensus are not that different, slightly lower, but we're looking at basically building houses and a slowdown in that market, perhaps. That's one thing. For Wednesday, we're looking at as well as the FOMC minutes, of course, which come out in the evening, European time evening, the US kind of afternoon. But we've got retail sales. Now that is interesting again because retail is a very important metric for the health of the economy, and we know that if inflation is high and the Fed is raising rates, one of the data is the economy heading for a recession? Well, we've had a technical recession number already, but let's say actual, drop of spending power, so people buying less, and so basically consumer spending is very important because if there's a negative reaction to the rates being higher in the QT, that impacts consuming, etc. So the Fed will be watching that as well, so etc. So what it means in theory is that it's the higher the number, the better for the Fed, who can continue raising rates, and the worse for equities and stock market, because they'll see that the Fed is not slowing down as much as they thought, etc. And just really to see how at the moment it sort of seems that the market is ignoring any bad news of the Fed sort of continuing on its path and wants to do its own thing, ignoring markets. One aspect of that is if you look at the FedWatch Tool by the CME group, you'll see that if you go to the CME group and count down to FOMC for the September, so the current target is 225,250, and the most probability is for September going into 275. You do the maths, 225 to 275 is a 50-point rate hike. Okay, so that means the 61.5% is for that versus 38.5 for the 75, which would take you to 300. And then if you go from that to the November, so remember 275, from that to 325 would be 50 points, 50 basis points. That's a 50% chance. Okay. So what the market is implying is that for September we're going to have a 50 basis points as the biggest probability, and then the biggest probability for the November meeting is going to be again 50 points. That's the highest probability. And then for the December, from 325 we go to 350, which would be 25 points. So we're going to go 50, 50, and 25. No mention of a 75 as the strongest possibility. So when we come to Wednesday, we've got the FOMC meeting minutes. Is that going to be revealing anything that we don't know, that the market doesn't know already? Efficient market hypothesis and all that already priced in, but it might be the spark for something. I don't know. Thursday is going to be jobless claims again, home sales, expecting to be an improvement from -5 home sales to -4. Jobless claims is going to be actually an increase, so bad for the economy, I suppose. But we've had very positive NFPs earlier this month, so really difficult to navigate this and with a straight head and really interpret it in some kind of directional signal. So I would say well out of it and really just concentrate on what we see around this level, which I've highlighted. So just to conclude, I will put timestamps on this. So if you're watching this to the end, or just skip to the end, go to the description and you'll see all the different timestamps. You can skip to the bits that you want. Thank you very much. A very long video, but well worth going through these things because there's a lot to explore there. Interesting times ahead. Stay safe and please like, comment, subscribe, and share this video. And please, if you want to know more, just get in touch with me. I'll be happy to point you to any of these sites. We'll put the links in the comments in the description section. Thanks very much for watching. Take care and see you in my next video on Friday.